We'll move beyond words by your presence here today. We thank you very much for being here.
Okay. Good evening. Just give me a moment. Okay. Good evening, students. And let's welcome ourselves to the second class of the day, which is advanced taxation. We are still on the basics of advanced taxation so that you will be able to answer questions that relates to bigger taxation matters. Now let's share our screen so that we will get to our topic for the day. Okay. The topic for today, hold on. This thing has freezed my system. Hold on. Okay. Trying to scroll down. Okay. We are going to be doing capital allowances and loss relief. Capital allowances and loss reliefs. So these are important topics that we need to know so that we can move on in understanding taxation. Okay, so we all know the rules for our class. The most important one I want to emphasize here is muting our videos and audio so that we can have proper coordination. That's the most important one I want to emphasize. Okay, so now we want to go into the lecture proper, part 2, which is capital allowances. Now, this capital allowances concerns sole proprietorship, partners, and companies. And so anybody who is doing business, if you have assets, your assets can qualify for capital allowances if they are qualifying capital expenditure. Okay, now this is the initial allowance and annual allowance rates which we'll be using for the class. Then we know that investment allowance is 10% on the cost. Now this is the calculation of annual allowance. The main formula you know is the cost of the assets, divided by the predetermined number of years. Now this predetermined number of years, how do we know it? We do not just pick any year, pick any number of years and say, okay, this is what I want to predetermine it. That is the difference between depreciation and capital allowance, because the years is predetermined by the tax authority. Now, we do it with this annual allowance rate. So what we do here is we say 100% divided by any of this annual allowance rate that corresponds to the assets. That will give you the number of year. So if we are to say plant, okay, if we are to say office building, which is 10%, we'll say 100 divided by 10 will give you 10 years. If it is motor vehicle, you say 100 divided by 25, you have 4 years. So that's how we get the number of years. Now, after getting the number of years, we sometimes do not use this M/12. This is because it's not in all cases we use it. For example, if you are on the first year of use for that asset, if that first year of use, if the basis period for that year is less than 12 months, you have to prorate it by saying M over 12. M means the number of months the asset was used for that year, divided by 12 full months. That is how we get the, so anything you get here, you prorate it. Now this applies to the first year the asset is being put into use. It also applies to the last year that the asset was put into use before it was disposed. If it was disposed before the end of the basis period, you have to calculate the number of months the asset was used and prorate it. Okay? Now, after you have finished the predetermined number of years and it is not disposed, let's say it's motor vehicle that is for 4 years. After the 4th year, when you get to the 5th year, you find out that your M is 0 because you are no longer charging depreciation or capital allowance on the asset. So we will say M is 0. And anything, if 0 divided by anything is 0, 0 multiplied by anything is 0. So your annual allowance will become 0. So it means that once you have reached the predetermined number of years, after that, the annual allowance is 0. You don't charge anything on it. Okay? Then this is the rural allowance, investment allowance. Then we talk about basis period for capital allowance. I will solve a question now, and you know that the basis period for capital allowance is supposed to follow that of profits. So where the profit, assessable profit basis period starts and ends, that is how capital allowance is supposed to follow suit. But there is a problem when we have overlapping basis period as we have in commencement, and sometimes gaps when we have in change of accounting date and perhaps in cessation. When that happens, capital allowance basis period does not allow overlapping, neither does it allow gap. So we'll see how we'll look at them. Then we also have restriction on capital allowance. The restriction is normally 2/3 of assessable profit. 2/3. It can also be called 66 2/3%. Note here that this one has percent, while 2/3 does not have percent. They are the same thing. If you are to simplify 66 2/3%, your answer will become 2/3. So don't go and write 66 2/3 and ignore the percent. You are wrong. If you do it like that without the percent, you are wrong. So I advise people to just say 2/3 instead of 66 2/3%, because there's a chance you will ignore the percent. Even though you write 66 2/3% correctly, when you are doing the calculation, use 2/3. These are applicable to any company that are not in the agro-allied, that is agricultural based, nor manufacturing industries. If you are not in these two categories, you face this restriction on your capital allowance. But you are in this category, you don't face those restrictions. Now, there is a difference between profits on cessation period and profits on and capital allowance on cessation period. When you get to the ultimate year, which is the last year of business, let's assume you have a loss of 500,000 in that year. There is no way the business is continuing forward. Normally, your losses are supposed to be carried forward. But when it gets to the final year, which is the ultimate year, any loss you make that you cannot carry any forward, it's lapsed. You've lost them forever. That's why it's called loss. Now, when it comes to capital allowance, when it gets to the last year and it is unrelieved, there is a remedy. You can bounce back and go backward 5 years. So now you are in the ultimate year, the business just ended. You have unrealized capital allowance. What happens? You go to the penultimate year and try to relieve it. If it is not fully relieved, you go back again the second year, go back until you get to the 5th year backward. Anything that cannot be relieved after going backward 5 years cannot be relieved any further. We will see how we will solve questions on all of them. Okay, so now let's get straight to question number 1 and let's get right into the business. It says here, James Nigeria Limited. Now this is a company. It could be James Nigeria Ventures, anything, but then this is a company. Now the key word here is commenced business. Now we know that commencement rule will take place. Now commencement rule will take place. Now when we say commencement rule, now this is a textile manufacturing company. So the word manufacturing here shows that it is not going to have restricted capital allowance. So we don't need to do 2/3. So these are the key things you mark. Now this is the date of commencement. It's important for accessible profit. Now, it was incorporated in March 2001. Any significance? No. This date is not significant in preparing our account because this is when the business started. But of course, this date is important for just the first year only. Now, why is it important? The law says that the first account you are going to file, the first financial report you are going to file should be 18 months after the date of incorporation or 6 months after the end of the first year of business, whichever comes first. And so let's say this business started 15th March 2001. That is when it was incorporated. This is the date on your CAC certificate. And you decided to start your business on January 2003. You see, you are going to file your returns 18 months after the date of incorporation. All you need to do is you write and tell them business has not started. You file new returns, new returns, new returns. When you start your business January 1, 2003, that will be your year 1. Understand? That's good. Now, so this date is just important when we are talking about the first filing. But apart from that, in fact, in our tax class, this date for incorporation is not important. So this is the most important. Now, where is the account ending date? You see it is 31st March 2002. So I believe now we are recurring what we did the last week. Now the basis, okay, now you are seeing company incur the following capital expenditure. Now, note here that the business started June 2001, and we are seeing things that were bought or incurred in the months before the business started. These ones was incurred before the business started. How do you treat them? You treat these two as though they were incurred on June 2001. It's as if you incurred them on the first day of business. That's how you treat them. So even if they wrote March and May, just come by the side and just write put a bracket and write deemed June 1, 2001. So it is deemed to have been purchased in June 1, 2001. All right, now we are asked to find the basis period alone, just the basis period for assessment. When they say assessment, is assessable profit. And that's not only that, and for capital allowance. For how many months? For the first 5 years of assessment. So we have to ask ourselves, what is the first year of assessment? The first year of assessment will start from the year the business started, 2001. So what we need is 2001, 2002, 2003, 2004, and 2005. These are the 5 years they need. All right, now let's do it. Okay. Hold on, let me get to my solution. Good. Now, here is the solution. So we look at the year of assessment here. This is 2001, 2, 3, 4, 5. Now, you know how we do our basis period. So let's start. The basis period will begin from the date the business started. That is June 1, 2001. And it will end on 31st December of that same year. We know all that. The second year is still going to be June 1st, 2001, but it has to be 12 full months. So how did we say we're going to calculate it? All we need to do is look at June 1st. Ask yourself, what was yesterday's date? 31st May. Then if this is 2001, just add one more year to make it 2002. That will be your end date. You understand that? Now, 2003, the third year, what we normally do is we start from the ending and we check the account date, the year end. So now we look at, this is 2003, that's fine. So it must be preceding year basis. So this must be 2002. Then we'll ask yourself, what date did they end their account? If we look at the question here, they normally bring the account in 31st March, which is 31st of 3. So why are we not having 31st of 3? We are having 31st of 5. Is it a mistake? It's not a mistake. Now, if we are to put, assuming for a moment, this is 31st of March. Now, what will here be the beginning? Here will become, you ask yourself, what is tomorrow's date? April 1. So here should be April 1, right? 2001. But what happened in April 1? The business has not started in April 1. The business started on June 1. So you cannot put a date where the business has not started. And so because we cannot get 12 full months on the third year, we just simply repeat the second year as the third year. So that's why you see this an exact replica. So now we'll go to the fourth year. The fourth year is going to be preceding year basis. So this is 2004. That means here must be 2-3. You ask yourself, what is the account ending date? It's supposed to be March 31st, as we wrote here, March 31st. So that's done. You ask yourself, what is tomorrow's date? April 1. April 1, you remove 1 year from here to be April 1, 2002. So that's it. So after getting this one, you start doing it accordingly. So you keep increasing the year. 2003, here is 2004. Fine. So we've done. The skill of this particular question is for you to know how this basis period is being formulated. That's important. Now we've done that for basis period. We don't need to come and do a separate one for capital allowance. We still need to take. So we do it like this now. Now, how does capital allowance work? Capital allowance work in conjunction with basis period. Wherever basis period starts, that is where capital allowance is supposed to start. Wherever basis period ends, that is where capital allowance basis period ends. Sorry, accessible profit rather. Now, look at accessible profit starts June 1 when the business starts. Capital allowance will start the same. It is always that for first year. Look at where it ends. This is where it's going to end. No problem. First year is just a copy and paste, no issue. Now, look at the second year. This second year is the same date that this one starts. So you ask yourself, that means there is an overlap if both of them are starting on the same date. There is an overlap. But capital allowance does not like overlap. So it will not start on the same date. It's going to start on a date that does not overlap here. So let's see whether we will achieve that. Look at the ending date, 31st May 2002. You cannot find it in the previous one. That means if this one is longer than this first one, so there is something that you cannot find here. So since this one cannot be found here, we'll put the same ending date here. So we've established the ending date for the capital allowance that is supposed to end with this. Beautiful. Now, when will it start? Since it cannot start here. Okay. So all we will need to look at is, let us find a way not to get overlap and not to get a gap. The only way we can avoid overlap is not starting from here. The only way we can avoid a gap is by starting on the next date after this date that the previous one ends. So you ask yourself, if this is 31st December 2001, what is tomorrow's date? January 1, 2002. That is ensuring that there is no gap from the last period to this period, and there is no overlap. And this ending date shows that both of them ends in the same basis period. They are not exceeding the basis period for profit. So you can see that even this period you mentioned here is still inside here. We can find January to this date here. So you see the capital allowance period, basis period is supposed to be inside the accessible profit basis period. Okay, now let's go to the third year. If you can remember, this year was a direct repetition of this one. So everything here is an overlap of 2002. So since everything is an overlap and capital allowance does not agree with overlap, we put dash. It means there is nothing here. We cannot charge capital allowance here. Now we go to the fourth year. Let's see. Start from the beginning here, April 1, 2002. Can we find April 1, 2002 here? Yes, we can, because this one ends in May. So we have April before May. So that means there is overlap of 2 months. There's an overlap of April, there's an overlap of May. So we cannot start capital allowance on April. All right, let's check. Can we end? Can we end here? Yes, we cannot find this date in the previous one, so we can end here. So since we can end here, how can we start? We look at this date. What is the next day after it? After May 31st is June 1. So we see that June 1 is inside here and it's ending here. So your capital allowance basis period could be more than 12 months in the case of gaps. In the case of gaps, it could be more than 12 months and it could be less than 12 months. So now let's go to the last one. We found out that this one here is not an overlap of this, and this one is a continuation from where this one stops. So there is no overlap and no gaps. So if that's the case, everything that is here will be the same thing here. If you look at it strictly, this date here is directly the next day after this. And this one ends where this ends too. Somebody is trying to ask a question here. Let me see. Question. I presume that CA of small companies. See, companies, I have not distinguished between large companies and small companies. Companies is companies. Companies is companies. So when you say you presume, I am not talking about the new finance bill. This lecture has nothing to do with new finance bill. So if it is have to do with new finance bill, we will say according to Finance Bill or Act 2019. This lecture has nothing to do with that. So let's put our mind on this first. It has nothing to do with new finance bill. So that's why we are using the basis period as we know it before the new finance bill. The new finance bill, if it is going to be tested, it might just be a discussion. For now, the calculation will not be tested. Okay, so now that we've done this part, let us look at the capital expenditure that we are going to be charging. So if you look at the question here, factory building fall in 2001, machinery fall in 2001, furniture fall in 2001. That's why you are seeing them here. Then between, so now you're not looking at this date anymore, you're looking at this date anyone. You're looking at this date now. Between January 2002 to May 2002, which assets do we have? We have van and we have motor car. That's why you are seeing them here. Then between April, sorry, I'm not looking at here, we're looking at here between June 2002 to May to March 2003. So this is January 2003. So we have office equipment. Mr. Tokpe, we are talking about restriction of capital allowances based on companies that are agro-allied and those that are manufacturing alone. Okay, when we say small businesses, when did the small businesses enter the restriction or go out of the restriction? Can you quote your sources? And I said if your source is based on the new Finance Act, that is not what we are going to. That is not what we are talking about. Our lecture does not incorporate Finance Act 2019. So if your source of small company is based on 1 million or 25 million, quote your source where you see that. And if it is not based on Finance Bill or Finance Act, it is accepted. So for now, we are only concerned with agriculture and manufacturing. Apart from those two, any other company you see, put 2/3. So they didn't even tell you their revenue. Sometimes you will not see their revenue in the tax question. You will not see their revenue. All you will see is accessible profit or adjusted profit. Or you will not see their revenue. So there is no way we can even say small company. That is the point I'm making. Okay. Now we've seen that these companies, the company has all these assets, but, and these are the periods that we can charge capital allowance. Now we say charging capital allowance. what we are talking about here is only initial allowance. This is because initial allowance is charged once during this period when they are first used. Annual allowance, you keep charging every year. So what we mean is that in the year 2001, these people here will be charged initial allowance and annual allowance. They will also be charged annual allowance here. They will also be charged annual allowance here and here and here. All these items we put here are the items we are going to charge initial allowance only. So that's the point of this basis period, for initial allowance only. Now we're done with the first part of the question. The B part says compute the capital allowances. So that's computation due for 5 years of assessment in respect to the capital allowance incurred by the company. So what do we do now? We are going to do a copy and paste. We'll copy here we'll copy this year of assessment. We will jump assessable profits, so we don't need this. Then we will come here and put this capital allowance, and we'll put this qualifying capital allowance. We're going to put here. So this is the thing. We're going to put this first column, year of assessment. We will jump here. We'll put basis period for capital allowance. We'll put qualifying expenditure. Then you will see another table for initial allowance, annual allowance, and total allowance. So that is exactly what you see here. So this is a copy and paste. These three columns are copy and paste. So I will not be talking much about them. So I will concentrate on these three columns. How do we get the figures here? Okay, so we will need to go to our table and look at all this capital allowance rate for us to know what to do. So now look at the initial allowance for 2001. There are 3 items we bought, so we are going to look at just those 3. The first one is factory building. So if you look at the rates, factory buildings can also be called industrial buildings. Initial allowance is 15%. So what we did here was 15% of the cost. What is the cost of the item? The cost of the item is 3.5 million. So we say 15% of 3.5 million. That will give you 525,000 naira. So this figure you put here, that's the same figure we had here. Now, machinery is 50%. If you go to the table to check, if you go to the table to check plant and machinery, that's 15%. When you get the plant and machinery 50%, you look at the cost of the assets, 50% of 2,800,000. So 50% of 2,800,000 will give you 1.4 million. And that's what we did here. It's 25% initial allowance. So that table I gave you is important. 25% of the cost, which is 750, to give you 187,500. That is what I did here. And so when you add these 3 figures, to give you the one in bold here. So let me discuss the initial allowance before I go to the annual allowance. So you go to the second year, you do the same principle. Motor van is 50%, motor car is 50% of their costs. That's 250 and 600. The same thing. When you add them, you have 850. Then, of course, in the year 2003, there was a dash, and there was a dash, so there'll be a dash here. In 2004, we have one item equipment, which is 50% of 600, which is 300. That is what we have here. So good, we now know how to do our initial allowance. Okay, so let's see how we will do our annual allowance. How would we do our annual allowance? So hold on a moment. Let's get to our annual allowance. Okay, now, how do we do our annual allowance? If you look at the annual allowance, you find out that there's a note here. Factory, building, and machinery that were bought before June 1, when the business commenced, were deemed to be purchased on the date of commencement of business. So the date of commencement of business is June 1. So that's when we assume that they were bought. So take note of that fine point. So factory building, annual allowance is what you'll be charging every year. How do we get annual allowance? You have to get the cost of the assets minus your initial allowance. Whatever it gives you, that is your numerator. Your denominator is the what we come on under the divide sign, under the division sign. Your denominator is the predetermined number of years. And we told you that the predetermined number of years for factory building is how many years? It's going to be 10 here. So we will say 100 divided by 10. That will give you 10 years. So these two figures, when you minus it, it is your numerator. When you say 100 divided by 10, that is 10, that will be your denominator. So you say numerator divided by denominator is going to give you 297,500. Now, this is what is your annual allowance. This is what you're supposed to be charging on year 1, on year 2, on year 3, down to year 10. But you cannot charge this full amount on year 1 just the way you did initial allowance. You have to prorate it on year 1 because you did not use 12 full months. So how do you do it? That is where our M over 12 comes in. So how many months is in that period? So let's check how many months is in that period. So between this period and this period, we have June, July, August, September, October, November, December, 7 months. So we are going to be saying 7 months is when we use it out of 12 months in a basis period. So when we prorate this figure, sorry, this figure here is 297. There is an omission of 9 here. So you put your 9. 297,500 times 7 over 12 will give you this figure. So this figure is what we use for factory building for the first year. And so if you look at it, that is exactly what I did here. For the first year factory figure, factory building, this is it. Now let's get down to the second one, machinery. This is your costs. This is your initial allowance. You get your numerator. The rate, the percent. And since it is 25%, it means that you have to say 100 divided by 25, which will give you 4 years. So 4 years is your denominator. So this minus this will give me 1/4. 1/4 divided by 4 is going to give me 350,000. This is what is supposed to be charged every year. But for the first year, you're going to prorate it for 7 months. So that gives you this figure. And that's what we wrote here, this figure. Now, the third one here, the same process. Numerator cost minus initial allowance. This one is 5 years here, gives you this figure. You now have to prorate, but not for 7 years now, not for 7 months now. Let's see how many months. You go back to your question and you see that when was this furniture bought? This furniture was bought, furniture was bought when? October. So if it was bought in October and this period is December. So we have October, November, December. That means we're talking about 3 months here out of 12 months. That is how you prorate it. When you prorate it that way, you have this 28,125. And that's what we have here in our answer. So we've done the whole thing. You add them up, you get this. So that's your annual allowance. So this is your initial allowance. This is your annual allowance. And when you add the two together, you have your total capital allowance here. That's clear. Fine. Okay. Then what will happen now is this. We'll go to the second year, 2002. So the second year, 2002, we have motor van and car. We'll look at when they were purchased. The motor van was bought in February. So what we'll do now is this. February, and this basis period is from January down to May. Yeah, so what happened is that, how many months did you use it? Use it in February, use it in March, use it in April, and use it in May. How many months? That's 4 months. Four months. Okay. Now, 4 months. Even though the capital allowance basis period here is telling you January to May, it doesn't matter. You must put denominator as 12 because this January to May is because of gaps and overlap. That is why you're having this thing like this. But that is not what you use to prorate the denominator. The denominator for prorating must always be 12. The numerator will be from the date you bought the assets to the end of that basis period. So what you now do here is, this one is February, March, April, May, 4 months. So all you now do is costs minus initial allowance divided by 4 years, you get the normal thing for the year. You prorate it because 2002 is the first year the van was put into use. So you prorate it by saying 4/12 to get, you give you this. So that's what you are going to use for delivery van. Then the same principle applies to motor vehicle. Motor vehicle was bought when? Let's see when it was bought. Motor vehicle was bought in May. That year, the basis period ended. So it's bought in May. So it's going to be 1/12. So that's what it says here, 1/12. So we are prorating this 150 we got here by 1/12, which is 12,500. That is what we are using as this. So what is this 760? What is this 760? Okay, let's get to it. 760, how did we get 760? Okay, let's see. Now, I told you before that in this year 2002, this building, machinery, and furniture, we will still charge capital allowance on this year, annual allowance. We'll be charging them every year. So apart from charging annual allowance on, delivery van and motor vehicle, we will still charge on factory building and furniture. Okay, so what do we do now? So we'll go back again and say, all right, look at the full capital allowance we did for building before we prorated for that first year. This is the one we did for machinery before we prorated. And this is the one we did for furniture before we prorated. When you add them together, you have 760. So that is the 760 that you saw me writing here. Okay, that's the 760 you saw me writing here. And when you add them up together, you're having 793, 333. You add it to this 850, you are getting all of this. Somebody is asking another question. Sir, why are we calculating from February? It is the 28th. Okay, let me ask you another question. If the basis period ends March 31st and we use it March 31st, are you not going to count it for that period? Will you take it to the next month? As long as it is one day you use it in that month, you will give it for that month. Whether it is one day. We are not prorating based on number of days in a month. Did you use it in February? Yes, you give it for February. So, okay, now look at it now. An asset that was bought in December and the basis period for the year ends in December. Maybe you will give it full annual allowance, full initial allowance. Why did you not say, okay, since it is one day, let me take it to the next year? No, you will still give it full annual allowance, initial allowance. In the same vein, you will give it annual allowance. You will give it full for that month of December. It is now left for you on practical basis if you want to divide it for a day. If December is 31 days, you can now say for 1 month, 1/31. Then you can streamline it for 1 day. It is left for you. So you can charge 1 day, number of days. If you want to use that, if you want to use a month, as long as you use it in that month, you charge full. If you want to go by days, fine by you. So, but as long as it is used in that day, in that month, whether it is on the 1st of February or 28th of February, it is being used in February. Okay. Now that we've gotten this figure, now let's get down to 2003. Now you will understand that this factory building, machinery, and furniture, we will still charge the annual allowance here. And you know it's 760 already. We also do delivery van and motor vehicle, their annual allowance. Let's see how much it's going to give us. So let's, sorry. Let me leave here. Let's look how we are going to look at it now. So can you see in 2003, we still have this 760 that came from assets that we purchased in 2001, which is like what we calculated here. Now, assets we purchased in 2002, delivery van and motor vehicle, this was the figures we got before we prorated. When we add them together, we got 212,500. So when you add these two together, you are having 972,500. And that is what we got, 972,500. No asset was bought on that period, so there's no initial allowance. It's only annual allowance we had. And so that is the total capital allowance. Now, when we get to 2004, we have an asset that was bought here. Initial allowance is 300. Then what is going to be the annual allowance? You see, the annual allowance is going to be prorated for that year because that's the first year we are using it. So we are prorating it 3/12. So when did we buy the assets? We bought the assets in, when again? We bought the assets in January. And the basis period is March. So it's going to be January, February, and March, 3 months. That's why we are prorating 3/12. And we got this. So that's what we did here. Our initial allowance, our annual allowance is this. Then The other assets that we did 972,500, we are still bringing them again because we are still calculating annual allowance. And so we'll get this. Then for these other ones here that are 5 years, okay? So these other ones here, the annual allowance, all you need to do here is every other thing here we have annual allowance. So all you need to do here is for the last one, you bring 760, the 212 that we got before that gave us 972,500 plus this new one we just got 75,000. You add them together, gives you this figure. That's what we did here to get your annual allowance. So that's fine. So we've seen the workings. Now the next question says, compute the tax liabilities for the first 5 years of assessment. How do we calculate the tax liability? Now, we are going to be looking at this table again, this main table. Now, we will not be bringing capital allowance basis period. In fact, what we will just do is we will ignore these two tables, these two columns, basis period for capital allowance and qualifying capital expenditure, because we have dealt with it in the other table. It's just the figure. When we need capital allowance, we bring the figure. But what we need is year of assessment and this profit basis period. So these are the things we need. So what we now do here is we go to the first year. Now look at the first year, the year of assessment, which is the same thing as this, 2001. Basis period is going to be this year. So that's what we did. Basis period is going to be this. So what's our assessable profit? We know that this basis period, how many months are here? These are 7 months period. But you were given a 10-month period account, but we need 7 months. So all we need to do is to get 7 months out of the 10 months. So that's what we did here. Take 7 months out of the 10 months, and you get this 6,297,500. That's your assessable profit. Then our capital allowance is simply what we calculated here. So I'll come back here and this thing has hook again. I'll come back here and bring your capital allowance table. Okay, so let me take capital allowance table. So is this capital allowance I am bringing? That is what I am using here. And since there is no restriction, because we don't do 2/3 of accessible profits, it's a textile manufacturing company, we use everything. So when we deduct it from here, this is your taxable profit. So for taxable profit is your accessible profit minus capital allowance. So now we have our taxable profit as this. It is from here we pay tax. So if you look at our income tax, is a company. So it is 30% of your taxable profits. So that gives you this value. Your education tax is going to be 2% of your accessible profits. It gives you this. That done, we now go to the second year. The second year is 12 months period that begins from the beginning of the account. Now, if the beginning of the account gave us a 10 months period and we need a 12 months period, it means that we must take this first 10 months and look for 2 months from the remaining one here. So that's what we did here. This is a 10-month figure, and we are taking 2 months out of the 12 months remaining. 2 months over the 12 months of the other year to make up the 12 months. So when we do 2 over 12, so what you do is you look for 2 over 12 of this inner bracket. So look at, don't go and start with 7,500,000, you now put plus, and you now say 2 over 12, you will get a wrong answer. Do the bracket inside the bracket first. So you do 2 over 12 times 12 million. You get your answer. Anything you get, you add it to 7,500,000. When you do that, you will have 9,500,000. So obviously this one will give you 2,000. 2 million, I mean. So when you add 2 million to 7.5 million, it give you 9.5. Then you bring your capital allowance from the second year. That is what we are using to relieve from our profit. We will relieve the capital allowance from the profit. So this is your taxable profit from where we will pay our tax, company income tax, our education tax. As long as you have accessible profit, you will pay your education tax 2% from it. We'll go to the third year. That is exactly the same thing we are doing. You know, the third year was a repetition of the second year. And so we are having the same accessible profits. But our capital allowance will be different because we got a different answer here. So that's what we are using as capital allowance. So your taxable profit will be this. You find your tax and you look for your education tax. If it's not compulsory that you must add the two to get this. It's not compulsory. If you like, you leave them. But if you keep them, you have to double underline each of them. Now let's go to the fourth year. The fourth year, the accessible profit was given to us here. Okay. Now, this fourth year, you know, is preceding year basis from what we did. So the account is the one ending in March 31st, 2003. You will go to the one ending in March 31st, 2003. It's 12 million. So that's the 12 million we used here. And we'll go to our capital allowance. We got our capital allowance as this. That's what we used. And so you get your taxable profit. From there, you look for your tax and your education tax. Then we'll go to the last year, accessible. Somebody is asking, I thought from basis period for accessible profits should be used to prorate annual allowance, not date. I don't understand your question. We've calculated profits differently. We have done our capital allowance. That's why we did our capital allowance first. So we're just picking it. Now we are doing profits. Profit is different. I gave you basis period for profits. That's why your basis period of profit and basis period for capital allowance was done as the first thing. So go back and study it again. I don't understand the question. Will you be more explicit so that I can understand? So your profit here is 18 million as we got from here. It's 2005, any account ended in March 31st, 2004. Preceding year basis, this 1 year, preceding year basis. So we use that. Then your capital allowance is this figure here, which we got here, which we've calculated. So when you put down there, you less it, you have your taxable profit. From here, you look for your tax. And from this up one here, you look for your education tax. So that's fine. That's fine. That's fine. So now let's look at somebody is asking, why are we not using 1 over 12 to prorate annual allowance under computation of capital allowances? I don't understand. Why are we using 1 over 12? Because annual is 12 months. Annual allowance is 12 months. That's why we are telling you that it's supposed to be full year. full year. But in the first year, you did not use it fully. That's why we are prorating it. But in the terms of profits, we are looking at when did the basis period start? When did the basis period end? Normally, if it is not for exam purpose, you will be taking actual figures from when the period starts to when the period ends. But because it is exam purpose, we are taking it as occurring evenly. Now, we didn't say annual profit, we said accessible profits. Capital allowance, we said annual allowance. It's just like depreciation, that normal depreciation, which we take annually, but we call it annual allowance. There's nothing like annual accessible profit. So we are looking at the basis period for profits to look at how many period is covered in that basis period. That is our basis for proration. So if we are looking at the first year will be less than 12. The second year must be 12 months. The third year must be 12 months. All other months are 12 months except the first year. So I don't understand why we are saying, why we're not using 7. Okay, you are saying 7/12. I don't understand. Maybe we have to talk about it in a WhatsApp class so that you will not confuse me. We'll spend 1 hour on this particular question and I still don't get your question clearly. Maybe you may send me a voice note to the general class so that everybody will understand the question and get what we are saying. So send me a voice note. Even right now, you can send your voice note if possible. In exercise 2.2, we'll still be doing basis period. So you still get it clearer. Exercise 2.2, the company is engaged in the energy resource is a company engaged in the incorporation and sale of new electric cookers. So what are they into? They are not into agricultural company. They are not manufacturing. So they are they're not into manufacturing. So we prorate, we use the restriction 2/3 on their accessible profits. Now that's one part, you know. This is also a company, so their tax is going to be 30%. That's another thing, you know. Now the company is ceasing business. So when the company ceases business, look at the date it ceases business. 2008 is the date it ceased business. So this year becomes the ultimate year. That makes 2007 as the penultimate year. So these are the things you glean from this first paragraph. Now look at the result they give you. Now this one they give you year ended. So you see, when they say year ended, is 12 full months, 12 full months, 12 full months. Now, this year ended is different from year of assessment. So sometimes profits, accessible profits can be given to you in year ended, or it can be given to you as assessment year or year of assessment. But capital allowance will always be reflecting year of assessment, not year ending. It's only profit that can use both ways, but capital allowance is always year of assessment. That's beautiful. Now, when we say year ending 30th September 2001, in 2000, it means the year of assessment will be 2001. So if I were you, I'll come here and write YOA and start putting 2001 here, 2002, 2003 to follow this. Because you'll be surprised, I'll be taking figures with 2000 and be taking figures 2001 in the same period, because this is year ended, not accessible, not assessment year. So year ended, you have to use preceding year basis. So if anything is ending 2000, it will be assessed in 2001. So that's another thing you should do. Just come here and put your year ended and put your 2001 down to 2008 year that we have 27. Okay, then that's the next thing. They now said balancing allowance. So balancing allowance is a kind of allowance that should go and that should be added to capital allowance, but this is only done at the end of the disposal of an asset. So when they disposed all the assets of the company, why will we get balancing allowance? It is because, let's say our tax written down value is 1 million. And you now sold the asset at 800,000. If you have not sold the assets, you would have claimed your capital allowance up to 1 million. But because you have sold the asset at 800,000, that is what you have realized. The 200,000 that you have not realized should become a balancing allowance that you should claim from the tax authority. That is what we mean by balancing allowance. It is because you sold your asset less than the tax written down value. Now, we have ceased business, we sold all our assets, and we sold it less than what they should be by the books. And so this is the balancing allowance that we have not claimed. Now, compute the company's income tax for 2001 when the business started down to 2008 when the business ends, giving all relief as much as possible. And I told you when a business ends and there are unutilized capital allowance, we will carry it backward for 5 years. We are going to examine it in this question. Okay, so let's see the solution to this question here now. Okay, hold on. Okay, so I will keep this table in front of us. I will be referring back and forth. So the first year basis period, since it is September ending, it means that if I were you, I will be asking myself October 1 to September 30. October 1 to September 30. I can decide to come here and put the basis period by the side. Basis period by the side. October 1, 1999 to September 30, 2000. That is a basis period. I can come here and do my year of assessment here so that I will get them right. So if you see 2001, you start from October 1, 1999 to September 30, 2000. That's your basis period. Now, you are looking for your assessable profit. Since it was given to you, just take it. There's no proration on this. This is 12 years, 12 months. You take your 1/8 year for 2001 assessment year, 2001, take it 1/8. Now you come to your capital allowance for year 2001, you bring this. So that's what we did here. Now, this is your capital allowance. Why did we not put it down here? Because, hold on a moment, this capital allowance is bigger than profit. And secondly, we want to do restriction. So you put your capital allowance here first, this temporarily. Now, you ask yourself, this my whole 1,950,000. Can I claim all of them? No. The law says that restrict it by checking it with 2/3 of your assessable profits. If 2/3 of your assessable profit is smaller than the capital allowance, then you should take the smaller one. So 2/3 of your assessable profit will give you 1.2. Now you can see me putting it in two places. Why? It is not that you are doing it two places. This putting it in two places has a dual, it means it has a dual effect. The first effect of this 1,200,000 is this. If I am going to relieve 1,200,000 from 1,950,000, how many unrelieved capital allowance is left? 750. It is this 750 I will carry it forward to next year. That is it here. That means this one is what was not relieved. I can only take 1, 2. The 750 will go next year. That is why I am putting this one here. It's for us to know the capital allowance to go next year. Now I am putting it here because this is where it is really being used. You are taking 1, 2 to relieve your profits from 1,800,000. So 1,800,000 minus your 1,200,000 capital allowance will give you 600 taxable profits. So this is your taxable profit. 600 is where you claim your income tax, and you go to your education tax is from 1,800,000. So you see why I am putting my capital allowance relieved in 2 places. That is how I want you to do it. Now go to the second year. Your assessable profit was this figure, as we can get from the example here. It is this figure. So I won't be coming back to here because just know that I'm taking it from here. So your capital allowance brought forward from last year was this. The capital allowance for the year alone, just know I'm taking them from here, is this. So I won't be coming much often here since you know where I'm getting the figures. So you add them together. This is what you are supposed to claim for the year. The one unrelieved from last year and the one you actualize for this year alone. The total will give you the gross capital allowance you are claimable for this year. You will now subject this one to test. Can I relieve everything? You will do 2/3 of your assessable profit. So when you do it, you have this figure, which is smaller than this. So fine. So you put it in 2 places. We said before why we are doing it in 2 places. This is the remainder that will go unrelieved going to next year. Now this is actually what we relieved. This is your taxable profits from where you will be charged tax, and you have been charged your tax and your education tax. So I told you it's not compulsory to add the 2 of them together. So you have to double underline them. So you double underline your profits, double underline your tax, double underline your tax. Then you come to the 3rd year. 3rd year, this is the profit that was given to you. This was the balance of capital allowance from last year. This is this year's capital allowance, total claimable. Now your total relieved, you will now have to do 2/3 of 3.5 million. When you do that, you will get something higher than this claimable capital allowance. When you do 2.2/3 of this, you will get something higher. So since the law says you must choose the lower, that means you cannot be claiming more than your capital allowance. So if we are to do, if you are to, okay, your madam, your blood is too high. I just said it. He said if I were to repeat 2/3 of accessible profit, it will be too high. That is what I'm explaining now. Now, the law says that if you do 2/3 times 3,500,000, you are getting 2,333,033 naira. You cannot be claiming more capital allowance than you have claimable. It means that your 2/3 is bigger than this. What it tells you when you do 2/3 and it's bigger than this, what it tells you that you can claim everything. That is what it is telling you. it means that you can claim everything here, because what you are claiming here is not up to the maximum allowed. What you have, okay, it means that if somebody tell you that, okay, that you can, you are allowed to third of your salary, maybe your allowance, maybe they give you that your maximum is going to be 2/3 of something, and you brought something less than 2/3, nobody would ask you to go and take that 2/3. That means this thing you have brought, okay, if somebody say your costs should not be more than 2/3 of a particular item, and you brought a cost less than 2/3, they will grant your costs because it's less than the maximum cap. But when you brought something higher, they will now look at the cap. What is our cap limit? So that 2/3, when we say restrict, 2/3 is the cap limit, the highest you can go. But you brought something less than that, so you can claim everything. That's why when you claim it, nothing will be left for the next year. You bring it here, and this is going to be your taxable profit from where you charge your tax, and you charge your education tax as well. Now, you bring your profit for the next year, for the other year. Now, there is no capital allowance from last year now. There is no capital allowance from last year. This is the capital allowance you got for this year. Now, when you subject this thing to 2/3, you are getting something higher. What it means is that you can claim everything, because when you do 2/3 of 1.5, you are getting like 1.2. So I'll be 1 point something here, which is higher than this. So you claim everything. So nothing will go to next year. So that's what it means. Then when you get to the next year, this is your profit, and you bring your capital allowance, no previous one from last year. When you subject it to 2/3, so you will always be doing the 2/3, always. Now, when you do your 2/3 and you find out that it is bigger than the capital allowance you brought forward, then no need putting it. You bring your capital allowance full. So when you less it, you see here now that you are getting the same value. When you less 1.7 from 850 from 1.7, you get 850, your tax and your education tax. Now you go to 2006, the same thing happens. The capital allowance is smaller when you do 2/3. Now my area of interest is the penultimate year. That is my area of interest now. Now let's go to, because it's similar. Now coming to penultimate year 2007, we said the business ended in 2008. Penultimate year is 27. What happened? There is a law in penultimate year that you can choose PYB or AYB, whichever is higher. So your PYB is the basis period that ends in September 2006. So you go for September 2006, the basis period, and you take 950. And that's the 950 we got here. Now going to the AYB, AYB means it must be from January 1, 27, because this is 27, and it must end in 31st December 27. So you ask yourself, where can I get January 1, 27? Where can I get January 1, 27? It has to be in this place, because this account would have started from October 2006 to September 27. So January 1, 27 will be here. So we'll check from January to September where this account ends. How many months? It's 9 months. So we take 9 months out of these 12 months. That's on the first hand. 9 months is needed out of 12 months. We need a complete total of 12 months, but we can only get January to September here, which is 9 months. So we are taking 9 months. We don't need the October, November, December of last year, which is the remaining 3 months. We only need January to September from here. So we are taking 9 months. Then we are taking the remaining 3 months, October, November, December of 27 from here. So this is 10 months period they gave us here. We are going to take the remaining 3 months from this 10 months period. So when you do this over this times this, you get a figure. You do this divided by this times this, you get a different, another figure. You add the figure you get from tidying up here with the figure you get from tidying up here. If you add them together, you are having 660. So you ask, which one of these two is higher? So you see, I've underlined them double because I don't want to add them together. So that's why you underline them double. So this one is higher. So you see, accessible profits choosing, PYB, is higher, 950. Now your capital allowance is for the year. Now let's see the capital allowance for that year, 2007, is 950. Coincidentally, your accessible profits and your capital allowance are the same figure. You have to restrict now, of course, because this figure and this figure are the same. So you now do restriction. So it will give you 2/3 of this 950, not 2/3 of this 950. It's 2/3 of this 950 is what gives me this. But because this figure here is exactly the same as this figure here, your balance carried down and your taxable profits are the same because you are doing 950 minus this and you're doing 950 minus this. Okay, so this is what should be carried to the next year. This is from where we will charge tax. And we've charged our tax here, and our education tax is going to be charged from 950, which is the one choosing. Okay, now that we've done penultimate year, let's go to the next interesting one, which is the ultimate year. The ultimate year is always actual year basis. So it's going to be January 2008 to July 2008. How many months is involved in this basis period? 7 months. And we are given a basis period of 10 months from where to take from. So we are going to take 7 out of 10. So that's why we see 7/10. When we do it here, that is your accessible profit that we've chosen. Then your capital allowance brought forward. This was the capital allowance you brought forward from last year. Now, if we look at here, there is no 2008 capital allowances. All we did was they were sold and they told us that we had balancing allowance. We have balancing allowance on the year of disposal of this. So that's what I will now bring as the capital allowance. It's because it's part of capital allowance. I'll bring it as the balancing allowance. The balancing allowance there is representing the capital allowance. When you add them together, this is what you are supposed to claim. Okay? But now, look, something is happening here. We are supposed to do restriction, isn't it? We are supposed to do 2/3 of 175. But surprisingly, we are not doing it. Why? This is because the business is ending here. And so you should start claiming all your capital allowance as much as possible. So you claim all the capital allowance that you can in the last year. So if you have 2,666,667 and you have a profit from where to claim it, take all the profit as your capital allowance. So you claim your capital allowance as much as the profit can carry. Now the essence of this is to repeat your profit as long as this one is bigger than this. But if this one is smaller than this, you put everything, you don't restrict. If this is smaller than this, you put everything. So balance will be 0. Then there will be no carry back. But if this is bigger than this, carry the whole of profit and put here. The aim is to make your taxable profit to be 0. That is the aim, to make your taxable profits to be 0. So you bring your profit figure here, you repeat it here, you repeat it here. So here is 0. So you cannot charge income tax on 0. But your education tax must be charged on 175,000. Now, this capital allowance, we cannot take it to 2009 because no business there. Business has ended. The business has died. So the law says take it backward 5 times. So we are in the ultimate year. We'll start carrying it backward 5 years, starting from the penultimate year. Now let me do something so that you appreciate what we are doing now. I will go to my penultimate year and show you something. Okay, now let's look at our penultimate year. Okay, now I am taking it backward. Now this is my capital allowance carried backward. Now, when I come to the penultimate year, the tax I have paid, I am going to be refunded that tax because I want to use it as my profit. So now this is the profit we had before we paid our tax. This is the profit we had before we paid our tax. If you look at it here, this is it. It is from this profit, that we paid our tax. So since they are returning back your tax to you, so bring back this profit. And you tell yourself, I want to charge the remaining capital allowance from my profit. So now you are bringing back your capital allowance. So this capital allowance was this one we carried backward. So we have brought it here. You ask yourself, this capital allowance, is it bigger than the profit? If it is bigger, you put the profit again, just the way we did here. Just the way we did in the ultimate year. You put the whole of the profits here, put the whole of the profit. The aim is to make it 0. And when it is 0, what is the difference? 2,175. This is what will be carried backward. So your income tax, you're supposed to be 0 naira. You're not supposed to be paying income tax. So they are going to refund you the 95,000 naira you paid as tax before. This 95,000 will be refunded. Another way of getting this, sometimes in the exam, they might not give you taxable profit. They just want to do you carry backward. They might not give you this taxable profit straight. All they might give you is your income tax, 95,000. Now, how can you, from your income tax, how can you get back this taxable profit? Now, how did you get 95,000? You did 30 over 100 times 316,667. That was what gave you 95,000, right? Fine. Now do the opposite. If you say 95 times 100 all over 30, you're going to get this. Because from here you said 30 numerator divided by 100 denominator, you got this. If you are grossing 100 numerator, 30 denominator, you will get back this. So that shows you that they are refunding your tax for you to go back to the situation you were before you paid tax. So this was the situation you were before you paid your tax. So it is from there you are claiming all of them as capital allowance, so there is no tax to be paid. So this figure will be carried backward again. Now, if this figure is carried backward, what will happen? What will happen? Let's go to the next year before it. So the next year before it was, let's go up now. So can you see your taxable profit was 470? So that's what I recalled. Your taxable profit was 470 because you're going to refund your tax. Now that's 2175 is now being brought here. You will now look at it again. This capital allowance is still higher than your profits. That means your profits will still need to go to claim your capital allowance. The aim is to make here 0. The aim here, this one is a balance that will be carried to next year. That means the 141 you paid as tax is being refunded. And I told you if you do 141 times 100 over 30, you will get 470. Now, come back again to this year, you're having 850. How did we get it? Let's go up here. See my 850 here? That's it. So you bring your 850 here. Another way of getting this 850 is the tax you paid. In case they didn't give you your tax you paid, 100 over 30, get 850. Now, this figure is being brought backward. So you see the bar will do backward. And you look at it, it is bigger than your profit. You put everything. And when you put everything, here is 0. And there is a carry backward of 835. So how many years have we gone? We've gone 3 years. So let's go to the 4th year. 4th year, the same thing. You bring your taxable profit, like as I showed you. You bring back the capital allowance carried backward. It's still bigger. So you put everything down here. Put it down here. The essence is to make it 0. We have 250, 225 carried to the 5th year. Now the 5th year is the final year. If we cannot clear the whole 255, anything remaining will be lapsed. So now let's look at the 5th year. Now the 5th year, what is our taxable profit? Wow. The 5th year, our taxable profit happens to be this. So you see, it means that this one is now bigger than this. So if it is bigger than this, you will not prorate again. Oh, you will not do 2 over 3. Oh, you have done that before when you are doing the first ones. You have done all that. You are going to bring the aim is to remove all your capital allowance so that you have 0 capital allowance. So at this point now, when you remove your whole capital allowance, you are getting 0. This is because this capital allowance is smaller than this, so it can go. So, but if this was still bigger than this, you would have put this smaller one here, and the remainder I would have written here capital allowance lapsed or lost. It would have been the remaining figure here. It cannot be carried backwards. So that's one. The tax authority tell you, sorry, I can't help you with that. So that would mean that your taxable profit for that year is supposed to be this and not this as we had in that year, because we have claimed new capital allowance. So it's going to be this. Now your income tax is going to be 30% of this. So what happens is that instead of the 604 which you paid as your tax, they are going to refund you fraction and take only 536,500. How much are they going to refund you? They're going to refund you 65,700, which is the difference between the 604 and this one that you are paying. Now, surprisingly, do you know that when you say 65,700, if you say 30 over 100 over 30, 100 over 30 times 65, 700, it will give you 225, which is your capital allowance. So it means that this tax that was refunded to you is what enabled you to relieve your capital allowance. So they are going to refund to you this tax, and you are going to be charged just this in place of this. Now, your summary of tax paid will be as follows. For the 2001, you will pay this. 2002, you will pay this. 2003, sorry, the answer is 538,300. Sorry, 538,300. You correct it. In 2004, we have zero it. We have made it 0, 0, 0, 0. So this is the ultimate year. This is the penultimate year, which you carry backward 1, 2, 3, 4, and in the 50th year, we paid something. Now, I want you to see a similar example. Sorry, this 2015 past question paper is for skills, not professional level. I want you to go and check skills 2015 November question number 1 to learn a similar example of how you can carry backward should in case something similar comes in the exam. So this is skills November 2015. So you can write it down. So don't go and say, professional level, I didn't see it. To know it's skills. Forgot to write it, it's skills. So far so good. We've learned part 2 of our business income. Part 3 is all about losses. Now, I will talk about loss briefly. In loss, we have what we call the current year loss and the carryover loss. And one thing we should know about loss is that the loss from one part of the business for a particular year of assessment is used to relieve. If you have loss and you carry over to the next year, you're only going to relieve it from that same segment or line of business in the respect of company. And secondly, about loss is that when you are in cessation year, you don't carry your loss backward the way you did in capital allowance. Once you hit the cessation year and you have a loss, that loss is lost. That's why it is called lost. Another thing about loss is that your loss that you are relieving from your assessable profit can never be more than the actual loss. You can never have a loss higher than your actual loss. This is what I mean. Go to exercise 2.3 and let's see an example so that we understand what I mean. So I'll go to page 15 and get the question down. Okay, now look at this period. Now there is a loss here, there is a loss here, and there is profit, profit, profit. Now this thing I'm going to show you normally happens during commencement rule and sometimes change of accounting date. Now, this is period ended December 31st, 2004. When we say period, it means less than 12 or more than 12 months. Now the business commenced. So this commenced business. Now, this is an enterprise, so it's not a limited liability company. But since it's a business, the same principle applies. We are not asked to calculate tax, so no problem. Now, since it commenced business on July 2004, this period should be 2004 July to December, which is 6 months, right? So now what it means here is this. This is your profit. This profit relates to period ending. This capital allowance relates to assessable profits. Okay, so see what we'll do now. All right. Now, this is your year of assessment. Your assessable profits. How did we get for 2004? For 2004, this is 7 months out of, okay, they gave you the whole period, 7 months. Hold on a moment. Okay, 180. Here is it here. This is your 180 here. Fine. Now your capital allowance, you were given as 30,000. So this capital allowance cannot be used to claim a loss. So it means that we are going to carry this capital allowance forward to next year. We're also carrying this loss forward to next year. Now, when we get to the next year, what happened? You see, for basis period, it's still taken from the same period for 12 months. Somebody say, my screen is not showing, it's just showing a corner. Maybe I will need to share my screen again because I have not done anything. Let me share the screen again. Can you still see my screen? If you can see my screen, please say you can see my screen. I believe you can see my screen. Somebody say, I can see your screen. Yes, thank you. Very good. Now, for the second year, we are looking at from the same period for 12 months. So what we do now is this. Since it is taken from this same period, 12 months, and here is only 6 months. Since this is only 6 months, we are going to bring these 6 months, which is this. I've brought the 6 months. Then we are going to take 6 months out of here. So what does it mean? 6 months out of here. So 6 months out of this will give me 60,000. 60,000 plus 180 will give me 240,000. And that's a loss, right? Now, if this is the loss we are bringing to our account for this year, we are going to bring the loss from last year, which is 180. This is what we have brought. Now, when you add this 240 to 180, your total loss, which is available, is 420. But there is a problem. This loss of 420 is bigger than the actual thing. You cannot tell me that 180 plus 120 will give you 420. No. 180 plus 120 is supposed to give me 300. But not even that. We took just 6 months out of here. So all we need here is this 180. We took the whole of this 180 plus 6 months here. That is the actual loss that we are consigning. So it is not this 420 that is the actual loss. It is 180 plus 60. So the actual loss we are looking at is 240. So now we are no longer looking at 420. We are now saying your actual loss is restricted to 240. So that's it. Now your capital allowance for the year is 40. Then you bring that of last year, 30. When you add it together, you have 70. Since we are looking at loss, your capital allowance cannot be relieved. So your taxable profit is nil because this is a loss. Taxable profit is nil. We go to the next year. Now the next year, look at our basis period, 2001, 5 to 31st December 2005. it is going to still be from here. Year ended from January to May. So we are taking the whole of this 120. That's what we mean by this 120, the whole of this 120. Then we are bringing a loss from last year. So we said last year, instead of 420, it has been restricted to 240. We are now bringing this 240 because that was what we took as our final answer last year. We bring it down this year, we add it to 120, it is now 360. But this 360 is more than the actual loss because that 360 contains 180 plus 60 out of 120. And we have taken this whole 120. So that means we have taken 60 twice. Because in that 360, in that 300, in that 240 we brought down, it contains 180 plus 60 here. And we are adding 120 here, the whole of everything. So all we need to do, you have to restrict it to the actual loss that was involved in the whole calculation. So what was involved is this 120 plus this 180 and this 120. 60 that was in that 240 is inside this 120. So you take one, you cannot be bringing it twice. So when you add them together, it gives you 300. So the difference is 60 because we took 60 twice. So it's 300 that is the actual loss and not 360. So this is what we are dealing with. Then your capital allowance for that year is 40,000. And we are bringing 70,000 from last year. When we bring 70,000, we add it is 110,000. Of course, we cannot relieve it because we have a loss here. So your taxable profit is nil. So you cannot even charge tax. Now the next year, which is the account ending in December 2006, you have a profit of 140. Very good. Now you bring your profit of 140, you bring the loss from last year, which we said was 300 instead of 360. Okay? When you less your profit from your loss, it gives you a resultant loss of 160. That's fine. Then your capital allowance from the year, for the year is this. The one of last year, which you carried forward to this year, this one here, you brought it down here, is this. So when you add it, is 155. So you cannot relieve it from the loss here. And so your total profit is nil because you have a resultant loss. Then you go to the last, okay, the other year, you have 260 as your profit. You bring your 260 here as your profit. Then the loss from last year, you're bringing it in here. You relieve your loss from your profit. You have a resultant profit of how much? 100,000. You bring your capital allowance for the year. You bring the one from last year to join it. You have a total capital allowance of this. Now, this business here is not the business where we relieve. This company is not the company that is restricted to 2.2 over. Sorry, it's restricted. Sorry, it's restricted because it is not a manufacturing company. The business is not tell us it's manufacturing or agro-allied. So we restrict. So we look at 100,000 as your accessible profit. Now, when you restrict and you find 2/3 of it, it's going to give you this, which you repeated here. So when you less 205 from this, this is the capital allowance you are carrying to next year. This is the capital allowance you are relieving, which you did 2/3. You relieve it from this, you are getting 33,333 as your profits that you are supposed to charge tax on. Now, when you are charging your education tax, is on this for this year. The other one here is on this. But the other ones that have loss, you don't charge. Now, you go to the next year, which is the last one. You have 400,000 as your profit. There was no capital allowance for that year. Then you bring your outstanding capital allowance. You bring it down here, you add them together, you have a total capital allowance to be charged of this. When you do your 2/3 of this figure, you're going to get something higher. So you see here, you are going to relieve all your loss, all your capital allowance here. So put them here. This is now 0. So no capital allowance is carried to next year. So when you minus this, is going to give you a taxable profit from which you will charge your personal income tax by direct assessment, because that is an enterprise and not a company. Thank God you are not asked to find tax. All you would have done is to use your tax table. You will not say the first 300, second 300. That is what you are supposed to do, because the name of the company, you didn't see limited. You didn't see PLC. So, ladies and gentlemen, we've done part 2 and part 3 of our business income. We have done basis period for profits. We've done basis period for capital allowance. We've done how to relieve losses. Everything we are doing here hinges on basis period. We've still seen capital allowance, and we now said instead of profit and you get loss, how will you handle it? So I want you to go back and do repeat, relearn all the things we've done last week and this week, because it's the foundation of what we'll be doing henceforth. So when your other lecturer comes and he's telling you capital allowance, he's telling you basis period, he's telling you profit, you can now refer to this note and understand it perfectly. Any question you have, please send it to the WhatsApp group. If you cannot type, use voice notes. I will attend to your question. If you are referring to my material, please screenshot that part and perhaps put a highlighter to highlight the place you want to ask your question. If you can do that, then you ask the question and make it as clear as possible. If using a voice note will be the best, fine by me. I'll be sure to answer all your questions. Thank you so much for the wonderful class that we've had today. Thank you, and I'll see you again for the next class next week. Your other lecturer will take the next class, which is coming up which is coming up tomorrow. The other lecturer will take it. So feel free to ask your questions. Thank you so much and have a nice day.